importantly, we'll need those tax rate cuts to offset the deleterious impact of tariffs. Now, many countries will offset tariffs by devaluing their own currencies, meaning the purchasing power of the dollar goes up. That's certainly what China did in the first Trump administration. So we'll see what happens there.
Cathie Wood's audacious market forecasts are drawing attention once more. This time, she predicts a sharp increase in Tesla's stock price to $2,600. Wood, who is renowned for her innovative investment strategies, is not merely speculating. Rather, she is recognizing the crucial market dynamics and technological developments that have the potential to propel Tesla to previously unheard-of heights. She describes how Tesla is at the forefront of several disruptive industries, from advances in autonomous driving and artificial intelligence to changes in energy production and consumer behavior. Her research explores the wider changes in technology and finance, rather than just forecasting stocks. She describes how innovation is changing industries and redefining the global economy at an exponential rate. Wood contends that since Tesla is at the vanguard of this revolution, conventional valuation models might not be relevant anymore, and that investors who ignore these paradigm shifts run the risk of falling behind. As we dissect her observations, we'll look at the patterns that might help Tesla reach this lofty goal and what they signify for investing in the future. Would Tesla really be able to reach $2,600? What repercussions might such an increase have on the market as a whole? Come along as we explore these fascinating advancements in depth and determine what they might mean for investors navigating the quickly changing financial landscape of today.
So here again, I've presented this for a while now, but this is what many economists are focused on, the deficit as a percent of nominal GDP. It is close to 8%, and you can see the little X up near 2.5%, 3%. That is Treasury Secretary's goal over the next 4 years. And with the help of DOGE and all the cabinet heads now that Trump has called them to help with the streamlining, we think the deficit will get there because of measures that the government is taking now, and because we do believe that tax cuts and deregulation are going to turbocharge nominal GDP growth. The best way to grow out of a deficit, as Reagan did, or at least started the process in the early 80s, is to grow at an accelerated rate with increasing productivity. And as you can see in the early 90s, through 2000, the combination of the Clinton administration and the Gingrich Congress really did get us on the right path, and we ended up with a surplus that we have really not seen since the tech and telecom bust. We actually think we will see one. It may not be in this during this administration, but the wheels in motion, just like in the 90s, we think will carry forward. The momentum will carry forward. On the next chart, again illustrating tariffs, that was the source of government income in the early days of this country. And as you can see, the income tax and corporate tax rates did not come into existence until the early 1900s, nor did the Fed. And you can see the trade-off that's taken place. We think that President Trump is thinking about bringing back a little bit more of balance here. We'll see if he's able to accomplish it. But I think, importantly, we'll need those tax rate cuts to offset the deleterious impact of tariffs. Now, many countries will offset tariffs by devaluing their own currencies, meaning the purchasing power of the dollar goes up. That's certainly what China did in the first Trump administration. So we'll see what happens there. Okay, on to monetary policy. We've shown you this this chart for quite some time. Money growth is 3.9% on a year-over-year basis. That's in the purple there. It had been negative, and monetary policy works with lags. That's why we put the green line, which is inflation. We've lagged it relative to, or I should say, pushed ahead the money growth numbers. And as you can see, there's a little bit of consternation that inflation has not continued down to the 2% area or less. As you also know, we expect it to do so. The burden of proof is on us, to be sure. I think there has been a lot of pricing behavior recently as companies anticipate tariffs as part of their input costs and are trying to get ahead of it. But we think the resolution will be to the downside here, sort of following what money did. And one of the reasons our conviction about this has grown is the velocity of money, or the rate at which it turns over, is starting to roll over. When the velocity of money is moving up, people are confident, they're willing to let go of their money, splurge a little. That tends to turbocharge whatever monetary growth is out there. When the velocity of money turns down, then that detracts from the money growth out there.
In the meantime, the legendary angel investor Jason Calacanis is not holding back when it comes to GameStop's recent strategic move regarding Bitcoin. Bitcoin has been chosen to be included as a reserve asset by the retail company that is experiencing difficulties and is still looking for a business model that can be sustained. The move was humorously dismissed by Calacanis, who made the following remark: "If you're a public company that can't figure out a business model, just buy Bitcoin." Moreover, he made a veiled reference to the fact that such a strategy might only be successful if a person of the caliber of Michael Saylor were to invest an astounding $1 trillion in Bitcoin. The price of Bitcoin has not been significantly affected by the move, despite the fact that GameStop's stock experienced a momentary increase after hours. Within the cryptocurrency community, there are individuals who consider this to be an indication of increasing corporate adoption, while others, such as James Choi, who was a former lead analyst, consider it to be an indication of market exhaustion. Although GameStop's financial position is strong, with billions of dollars in cash and a market cap that exceeds $11 billion, the company's decision to enter the cryptocurrency market is still being hotly debated.
So on this next page, you can see the very long-term chart of the velocity of money. It has been in a downtrend since 2000. I think the reasons are, first, the tech and telecom bust was a real shock to the system. Then we had a little bit of a cyclical rebound in the 04-05 time period, and then continued down primarily because of the excesses that became clear in the housing sector, led to the crisis, the global financial crisis, which again put a lot of fear into consumers and businesses. So again, they hung on to their money, and that was exacerbated, of course, during COVID. There was a collapse in the velocity of money. You know, people seized up and just were very afraid to spend, wondering if we were going into a global depression. We've had the cyclical upturn from that extreme decline, And you can see we're starting to tip over. And if you look at the year-over-year percent change of velocity, which you see here, you can see that velocity turbocharged money growth when it got to 11% on a year-over-year basis. As of the fourth quarter, it's down to 1%. But if you look at it sequentially, velocity turned negative in the fourth quarter. I think it dropped by something around 1% from the third quarter to the fourth quarter. And we believe that fears about employment that I just described from such a huge swath of the employment base out there is probably going to cause a continued drop in velocity sequentially, which will turn into a year-over-year drop. So if money supply growth were to stay at 3.9% and velocity were to drop 1% on a year-over-year basis, then that would be a nominal GDP growth. This is mathematical. A nominal GDP growth of only 2.9%. And that would be either squeezing inflation out, squeezing real growth out, probably both. And so it didn't surprise us that the Atlanta Fed is now suggesting a decline of 3% quarter to quarter in real GDP. Now, some of that is a function of the massive increase in imports in the first quarter. In January alone, month over month, imports went up, I think, 12%. So on an annualized basis, that'd be the equivalent of well over 100%. So that's a real drag. Imports subtract from GDP. Now, the other side of imports, as they work their way through, is they either end up in inventories or they're consumed. So, we will see the other side of that import growth in the next few months. So let's see, we'll take you on now to, again, you can see the consumer was beginning to feel a little better about things, punctuated by, the election-related peak. And now it's unraveling a bit. And uncertainty, which is another metric in this index, is back near a record high. And that's understandable. There are a lot of moving parts as this administration takes over and owns its policies. And we also know President Trump, the art of negotiation, sometimes you need chaos to bring more and more people to the table. And that certainly seems to be working geopolitically. Another reason people are upset is, well, egg prices, bird flu, that's capturing a lot of attention, of course. But other prices have gone up in here. For a time, gasoline was going up. And this was the result of backup in inflation expectations. The Fed really doesn't like to see this. And even more so, the Fed doesn't like to see this measure of inflation expectations, 5 to 10 years ahead, increase to a level we haven't seen since, goodness, it looks like the late 90s. It might have even been 1994. Interesting, that again is the period when Clinton and Gingrich were wrestling the government sector to the ground. And of course, inflation fears were part of the reason back then as well. Oil prices have turned back down, and this president wants another 3 million barrels of oil produced in this country. And so it's taking off all kinds of regulations to encourage it. And of course, OPEC is now telling us they're going to increase supply in April. So we think oil prices are going to go down quite a bit, and that certainly will feed into inflation expectations. So we expect these measures to turn down in the months ahead.
Bitcoin is showing indications of a possible breakout. Some analysts predict that it will rise to $95,000 after briefly touching $88,500. Traders are starting to target the coveted $100,000 mark as market optimism rises. Market confidence is bolstered by strong miner reserves, growing adoption of Bitcoin ETFs, and institutional support. Short-term analysis, however, points to a potential correction to about $85,000 before the bullish momentum fully takes off. Sentiment data shows that traders are becoming more greedy, which is driving inflated price forecasts of up to $159,000. Bitcoin miners, meanwhile, are holding firm with reserves of 181,240 Bitcoin, or almost $159 billion. Technical analysis indicates a double-top pattern close to a significant resistance level, suggesting a brief decline prior to a possible rally, despite this bullish background. A run toward $95,000 and higher could draw institutional and retail investors, paving the way for an explosive move if Bitcoin can retest $85,000 and reverse upward. Many investors are still very hopeful about Bitcoin's long-term trajectory, positioning themselves for huge gains as the market reaches a crucial turning point, even though short-term caution is advised.